Welcome to our presentation on financial ratios and operating indicators. In this video, we're going to explore how these powerful tools can help healthcare managers assess and improve the financial performance of your organizations. But before we dive in, let's take a step back and understand why financial ratios and operating indicators are so important. You see, these tools provide insights into various aspects of financial performance, allowing you to identify strengths, weaknesses, and areas for improvement. Pretty cool, right? Now we're going to focus on four main categories of financial ratios: profitability, liquidity, capital structure, and turnover ratios. We'll also discuss the importance of operating indicators in assessing performance. So, let's get started. First up, profitability ratios. These ratios measure your organization's ability to generate profits relative to its revenue, assets, or equity. There are four key profitability ratios you should know: operating margin, total margin, return on assets, ROA, and return on equity, ROE. Operating margin measures the proportion of revenue that remains after deducting operating expenses. The formula is simple: operating income divided by total operating revenue. Total margin, on the other hand, measures the proportion of total revenue that remains as net income. The formula for that is net income divided by total revenue. ROA measures how efficiently your organization uses its assets to generate profits. The formula is net income divided by total assets. And finally, ROE measures the return generated on the owner's investment in the organization. The formula for that is net income divided by net worth. Generally speaking, a higher value for these ratios indicates better profitability. As a manager, you should track these ratios over time and compare them to industry benchmarks to assess your organization's financial performance. Moving on to liquidity ratios. These ratios assess your organization's ability to meet its short-term obligations. There are three main liquidity ratios: current ratio, days cash on hand, and days in accounts receivable. The current ratio measures the proportion of current assets available to cover current liabilities. The formula is current assets divided by current liabilities. Days cash on hand measures the number of days your organization can continue to pay its operating expenses with its current cash balance. The formula for that is cash and cash equivalents divided by total expenses minus depreciation, and then divided by days in period. Days in period refers to the number of days in the time period being analyzed. In financial analysis, this is typically the number of days in a month, quarter, or year, depending on the reporting period. Days in accounts receivable measures the average number of days it takes to collect payment from patients or insurance companies. The formula is accounts receivable divided by operating revenue, and then divided by days in period. Higher current ratio and days cash on hand indicate better liquidity, while lower days in accounts receivable is preferable. As a manager, you should monitor these ratios to ensure your organization has sufficient liquidity to meet its short-term obligations. Now let's talk about capital structure ratios, also known as solvency ratios. These ratios measure your organization's ability to meet its long-term debt obligations and the proportion of assets funded by owners versus creditors. There are three key capital structure ratios: times interest earned, debt service coverage, and equity financing. Times interest earned measures your organization's ability to pay its interest expenses from its operating income. The formula is net income plus interest expense divided by interest expense. Debt service coverage measures your organization's ability to cover its debt payments, including both principal and interest, from its operating income. The formula is net income plus interest expense plus depreciation, divided by interest expense plus current maturities of long-term debt. Equity financing measures the proportion of total assets financed by owners' equity. The formula is net worth divided by total assets. Higher times interest earned and debt service coverage ratios indicate a better ability to meet debt obligations, while a higher equity financing ratio suggests lower financial risk. As a manager, you should use these ratios to assess your organization's long-term financial stability and make informed decisions about capital structure. Moving on to turnover ratios. These ratios measure how efficiently your organization uses its assets to generate revenue. There are three main turnover ratios: total asset turnover, current asset turnover, and fixed asset turnover. Total asset turnover measures the amount of revenue generated per dollar of total assets. The formula is total revenue divided by total assets. Current asset turnover measures the amount of revenue generated per dollar of current assets. The formula for that is total revenue divided by current assets. And finally, fixed asset turnover measures the amount of revenue generated per dollar of fixed assets. The formula is total revenue divided by fixed assets. Higher turnover ratios indicate more efficient use of assets. As a manager, you should monitor these ratios to identify opportunities for improving asset utilization and increasing revenue. Now let's talk about operating indicators. These indicators complement financial ratios by providing insights into the operational aspects of your healthcare organization. They relate financial data to operational data, such as output produced and resources used. There are four main types of operating indicators: expense, price, efficiency, and utilization indicators. Expense indicators measure the cost of resources used to produce a unit of output, like cost per patient day or cost per visit. Price indicators measure the revenue received for a unit of output, such as net price per inpatient discharge or gross price per ambulatory payment classification. Efficiency indicators measure the amount of input used to produce a unit of output, like staff hours per discharge or supply cost per procedure. And finally, utilization indicators measure the amount of output produced by a resource, such as occupancy rate, average length of stay, or procedures per operating room. By using operating indicators alongside financial ratios, you can gain a more comprehensive understanding of your organization's performance and identify specific areas for improvement. Now let's apply these concepts to a real-world example. Consider a medium-sized community hospital with the following financial and operational data. Total operating revenue, $150 million. Total expenses, $145 million. Net income, $5 million. Total assets, $100 million. Current assets, $30 million. Current liabilities, $20 million. Average length of stay, 4.5 days. Occupancy rate, 75%. Let's walk through the calculations for the relevant financial ratios and operating indicators to assess the hospital's performance. First, let's calculate the operating margin. To do this, we'll divide the net income by the total operating revenue. So that's $5 million divided by $150 million, which gives us an operating margin of 3.3%. This means that for every dollar of revenue, the hospital keeps 3.3 cents as profit after covering its operating expenses. Next, let's calculate the current ratio. For this, we'll divide the current assets by the current liabilities. So that's $30 million divided by $20 million, which gives us a current ratio of 1.5. This means that the hospital has $1.50 in current assets for every $1 of current liabilities, indicating that it has sufficient short-term assets to cover its short-term obligations. Now let's calculate the total asset turnover. To do this, we'll divide the total operating revenue by the total assets. So that's $150 million divided by $100 million, which gives us a total asset turnover of 1.5. This means that for every dollar invested in assets, the hospital generates $1.50 in revenue, indicating a relatively efficient use of its assets. Moving on to the operating indicators, we have the average length of stay at 4.5 days. Let's compare this to an industry benchmark of 4.0 days. The hospital's average length of stay is slightly higher than the benchmark, which could indicate potential opportunities for improving patient flow and reducing the duration of hospital stays. Finally, let's look at the occupancy rate of 75%. Comparing this to an industry benchmark of 80%, we can see that the hospital's occupancy rate is lower than the benchmark. This suggests that there may be room for improvement in terms of optimizing bed utilization and increasing the number of patients served. Based on these findings, the hospital appears to have a relatively low operating margin and occupancy rate compared to industry benchmarks. As a manager, you should investigate the reasons behind these results and develop strategies to improve profitability and resource utilization. For example, you may focus on reducing expenses, improving patient flow to reduce length of stay, and optimizing bed management to increase occupancy rates. By performing these calculations and comparing the results to industry benchmarks, you can gain valuable insights into your organization's financial and operational performance and identify areas where improvements can be made. To effectively use financial ratios and operating indicators, healthcare managers should 1. Regularly calculate and track these metrics using accurate, timely data. 2. Compare your organization's performance to historical trends, industry benchmarks, and peer organizations. 3. Share the findings with key stakeholders and engage in discussions to identify areas for improvement. 4. Set realistic targets and develop action plans to achieve them. 5. Monitor progress and adjust strategies as needed. 6. Foster a culture of continuous improvement and data-driven decision-making. By incorporating financial ratios and operating indicators into your daily work, you can proactively manage your organization's financial health and drive better outcomes. So, let's recap what we've covered in this presentation. We've explored the importance of financial ratios and operating indicators in assessing the financial performance of healthcare organizations. We've covered 4 main categories of financial ratios: profitability, liquidity, capital structure, and turnover ratios, as well as the role of operating indicators in providing insights into operational performance. By understanding and applying these concepts, you, as a healthcare manager, can gain a deeper understanding of your organization's financial health, identify areas for improvement, and make data-driven decisions to enhance performance. We encourage you to start using these powerful tools in your own healthcare organization. By regularly tracking and analyzing financial ratios and operating indicators, you can drive better financial outcomes and ultimately improve the quality of care for your patients.